We're going to talk a little bit about what we're expecting from the jobs report this week. So this is going to air on Friday, the same day as the jobs report. So I kind of put Dan on the spot a little bit to be, see how his crystal ball is. His dad's won quite a few of the crystal ball awards, but this is Dan's chance to see how he predicts what might happen here with the jobs report. But also, we got a big Fed meeting coming up, and there's a lot of anticipation that there may be a Fed rate cut. Matter of fact, Dan will probably break it down for us, but there's a pretty high percentage of a Fed rate cut, but there are some things we got to get through before that meeting that could potentially change things. But one thing I also want Dan to talk about is the last couple times we've had some Fed rate cuts, we didn't see the big improvement in mortgage rates that we were expecting. So some people are even a little bit nervous on what happens if we get that Fed rate cut. What's it going to do to mortgage rates? So lots to unpack. This is kind of a preemptive conversation with Dan Habib. We're going to have him back after the Fed meeting. So Dan, thanks for taking the time. Let me put you in the hot seat as we kick off September with a much anticipated but very busy month for rates.
Well, thanks, Tony. And it could be a very good month for rates. We've seen rates trend a bit lower, and we all know that, boy, we'd love to see rates continue down and stay there for a prolonged period of time, because it's been a tough couple of years, but that would really do a lot for refinances and purchase activity. So right now, the market is focused on the September 17th Fed meeting. It's a two-day meeting, so the 16th and the 17th, but the 17th is when the Fed's going to deliver their announcement on if they're cutting rates or not, their statement. It's also going to have their SEP, or their summary of economic projections, where we'll get a new dots plot chart, which shows you where all the Fed members anonymously think the Fed funds rate is going to be this year and in the longer run, as well as where they think inflation, the unemployment rate, GDP, and other things are going to be. So the market right now is pricing in a 92% chance that the Fed's going to cut 25 basis points September 17th. So what changed, and what's causing the market to now think that the Fed's going to cut? Well, it was Jackson Hole, Wyoming, the symposium that they have there, where the Fed chair speaks every single year. And let me just make sure I'm sharing the right screen here with you. So I just want to go over with you some of his comments and show you why the market interpreted this as the Fed's going to cut. Because he didn't come right out and say it. You always have to look very closely at the verbiage that the Fed is using. So he finally pointed to the fact that the job growth slowdown has been much larger than they previously thought it was just a month ago. And now, obviously, as we'll get into, he's talking about the latest jobs report that we got for July, which showed some huge negative revisions, really making May and June much, much, much weaker. And he said the risks to the unemployment rate rising are really, the downside risks to the unemployment rate rising have really been more elevated. And if they materialize, that this can happen very quickly, you'll see more layoffs, you'll see rising unemployment. So he's finally addressing the side of their mandate, which is maximum employment, and they're putting a lot more emphasis towards it. Now, of course, they're worried about inflation going up, and they've been talking about how they're worried about inflation due to the tariff impacts. But now Powell saying his base case is that the effects of the tariffs will be relatively short-lived and a one-time shift in the price level. Now, that doesn't mean it's going to happen all at once, because we know there's still big trade deals that are out there with countries like China and India. But once everything is settled, it really is just a one-time price increase in his eyes, different than persistent inflation. So I was actually quite surprised and happy to see Powell finally acknowledging the slower labor market and being weaker than the BLS has been saying, only to revise the numbers lower, and to not be as worried about the short run inflation we're going to get from tariffs, because he thinks they're going to be one-time price increases. And then, of course, he talked about how the economy was growing at a slower pace, 1.2%, if you average the first two quarters and annualize it. So here was his bottom line, where the market said, okay, the Fed's going to cut. He said, with policy in restrictive territory, which means the Fed has room to cut before getting to a neutral level and still be restrictive, and the baseline outlook, which means inflation being pretty close to their target when you remove the one-time tariff impacts, and the shifting balance of risks, which means now there's a greater risk to the unemployment rate going up, it may warrant adjusting our policy stance. So this is Fed code here for, hey, the Fed is probably going to cut rates September 17th.